The words tax deferred, tax free, and tax advantaged are often used in financial conversations. Unfortunately, they are also often misunderstood. They may sound similar, but they do not mean the same thing. And misunderstanding the difference could affect how much of your retirement money you can actually spend. Today, we are going to look at these three terms, compare how they may apply to retirement accounts, annuities, and indexed universal life insurance, and discuss the questions you should ask before making a financial decision. Let's begin with the broadest term. Tax advantaged is an umbrella term. It generally means that a financial account, product, or strategy receives some type of favorable treatment under the tax laws. That advantage could take several forms. You might receive a tax deduction when money is contributed. Your earnings might accumulate without being taxed each year. Withdrawals might receive favorable treatment, or money paid to beneficiaries might be excluded from federal income taxation. But here is the important point. Calling something tax advantage does not automatically mean it is tax free. It only means that it may receive one or more tax benefits, provided the applicable requirements are satisfied. Now let's look at the next term. Tax deferred usually means that taxes have been postponed. The tax has not necessarily disappeared. It may become due later when money is withdrawn or when another taxable event occurs. Tax deferral can still be very valuable. When taxes are not taken out of an account every year, more money may remain available to accumulate. But eventually, you need to understand when the tax bill may arrive, how the distribution will be taxed, and how much of the account will actually be available to spend. Consider a traditional retirement account. This might include a traditional 401k plan, a 403b plan, a 457b plan, or a traditional IRA. In many cases, contributions are made before income taxes are paid. The money then accumulates on a tax deferred basis. That sounds attractive, and it can be. But when previously untaxed contributions and earnings are distributed, those dollars are generally included in taxable income. Imagine that someone looks at a retirement statement showing a balance of $1 million. That person may naturally think, I have $1 million available for retirement, but that may not be entirely accurate. If the account contains previously untaxed money, some of that balance represents a future tax obligation. The account statement shows the gross value. It does not necessarily show the amount the owner will ultimately be able to spend. That is why a $1 million tax deferred account is not always the same as $1 million of after tax purchasing power. Now let's consider a non qualified annuity. A non qualified annuity is generally purchased with money on which income taxes have already been paid. The owner deposits after tax dollars, and the earnings inside the annuity may then accumulate on a tax deferred basis. Again, tax deferred does not mean tax free. Before the contract is annuitized, withdrawals are generally treated as coming from the earnings first. This is sometimes called last in, first out taxation. The gain is generally taxable as ordinary income before the owner receives a tax free return of the original after tax principal. For example, suppose someone deposits $300,000 into a non qualified annuity. Over time, the contract grows to $400,000. The $100,000 increase represents gain. If the owner begins taking ordinary withdrawals before annuitization, the taxable gain will generally be considered to come out before the original principal. If the contract is formally annuitized, each payment may include both taxable earnings and a tax-free return of principal. The exact calculation depends on the contract and the method of distribution. An annuity can provide valuable benefits. It may offer tax-deferred accumulation. It may offer principal protection or contractual guarantees, and it may provide an income stream that the owner cannot outlive, subject to the claims paying ability of the issuing insurance company. But the word tax deferred should not be mistaken for tax free. The tax may simply be waiting until the money is used. Now let's look at Indexed Universal Life Insurance, commonly called IUL. An IUL policy is life insurance. It is not a retirement account, a bank account, or an investment in a stock market index. Premiums are generally paid with after tax dollars. The policy may then accumulate cash value on a tax deferred basis. A properly structured and managed policy may also offer access to accumulated policy value through withdrawals and policy loans. Under current tax rules, withdrawals up to the policy owner's basis may generally be received without income taxation. Policy loans may also be received without current income taxation, provided the policy remains in force, continues to qualify as life insurance, and has not become a modified endowment contract. A modified endowment contract is commonly referred to as a MEC or MEC. However, describing policy loans as tax-free income without explaining the conditions can be misleading. A policy loan is still a loan. Interest is charged. Loans and withdrawals reduce the policy's available cash value. They may also reduce the death benefit. If too much money is borrowed, or if the policy does not perform as expected, the policy may require additional premiums to remain in force. And if a policy with taxable gain and outstanding loans lapses or is surrendered, the policy owner could face an unexpected income tax bill. That can happen even though the owner does not receive any additional cash at the time of the lapse. The tax treatment also changes if the policy becomes a modified endowment contract. Distributions from a MEC are generally treated more like distributions from an annuity. Taxable gain is considered to come out first, and certain distributions may be subject to an additional federal tax before age 59 and one half. So an IUL can be tax advantaged. Its cash value may grow tax deferred. Access through properly managed withdrawals and policy loans may receive favorable tax treatment, and the death benefit is generally received by beneficiaries free from federal income tax. But none of those outcomes should be described as automatic. The policy must be properly designed, appropriately funded, carefully monitored, and kept in force. Now let's define the third term. Tax-free generally means that the applicable money is not included in taxable income, assuming all legal requirements are met. A familiar example is a qualified distribution from a Roth account. Another example is the death benefit from a life insurance policy, which is generally excluded from the beneficiary's federal taxable income. But even the term tax-free requires context. There may be exceptions. Different rules may apply based on ownership, transfers, policy changes, estate planning, or the way a transaction is structured. That is why financial professionals should be careful about making broad promises. The most accurate language is often potentially tax-free under current law, provided the applicable requirements are satisfied. So, how should you evaluate a tax advantaged financial strategy? Do not stop after asking, Aaron, does my money grow tax deferred? Ask what happens when you need to use it. When will taxes become due? Will distributions be taxed as ordinary income? Which dollars are considered to come out first? Could an early withdrawal trigger an additional tax or surrender charge? Are there limits on how much money can be accessed? Could a policy loan or withdrawal reduce other benefits? What happens if the account owner dies before using the money? What will the beneficiaries receive? And how much ongoing management does the strategy require? The central lesson is simple. Tax deferred means the tax is postponed. Tax free means the money may be excluded from taxation when the legal requirements are satisfied. Tax advantaged is the broader term. It means the strategy receives some type of favorable tax treatment, but it does not tell you exactly what that treatment is. These terms should never be used interchangeably. A tax feature can be valuable, but a tax feature alone does not make a financial product appropriate. The product must still match the client's need for income, liquidity, protection, guarantees, growth, living benefits, and legacy planning. The goal should not merely be to delay a tax bill. The goal should be to understand how the money will be taxed while it accumulates, when it is distributed, and when it eventually passes to the people you care about. Before making a decision involving a retirement account, annuity, or life insurance policy, ask for a clear explanation of the tax treatment at every stage: during accumulation, during withdrawals, during retirement income, and at death. Because the most important number is not always the balance shown on the statement. It is the amount you can use, the protection you can rely on, and the value that ultimately reaches your family. This presentation is intended for general educational purposes only. It is not individualized tax, legal, or investment advice. Tax treatment depends on the specific account or contract, its ownership, funding, distributions, policy status, and the individual's circumstances. Please consult a qualified tax, legal, or financial professional before making a financial decision.